Hey guys, just want to make this quick video here on what does an options play look like in real life and how to prep for both an inflationary and a deflationary environment. And it's not complicated. If I use any jargon, it's just that, but in reality, we're just talking dollars and cents here. And in our example, we're going to be using somebody with a net worth of $70,000 with an ability to save of $4,000, and they're able to borrow $80,000. I'm not saying go and borrow $80,000. I'm saying they're able to. And in our example, we're going to say that we always need to have $50,000 on hand to make some sort of major purchase, whether that's a down payment or a some sort of investment that's coming up. You always want to be able to have this $50,000 ready to go. And scale these numbers to your situation, not taking on more risk than you should. There's a very specific reason why we're using these numbers as a percentage of net worth, and it's important. Otherwise, the strategy doesn't work, and you're going to seriously damage your net worth. So, looking at our $70,000 in cash and taking into account our $50K cash reserve goal, that leaves us with this $20,000 here of investment capital, and we're actually going to dip into our line of credit here, or our borrowing ability, and we're going to borrow against that 20,000. So if it were to go to zero, we're still able to meet our $50,000 goal and make that major purchase, even if our investments go to zero. And that's what we want to be set up for in any situation. If inflation happens, we want to be prepared. We'll be happy. Deflation, we'll be prepared. We'll be happy. And stagnation, we're prepared, we'll be happy. So with that $20,000, we're going to want to invest that into something that will pay off in an inflationary environment to protect our cash balance, as the cash balance will do great in a deflationary environment. So we want to invest it into long-dated at-the-money options. And the reason for that is the long-dated holds the value, and the at-the-money keeps them. These are just high quality options. They don't decay as quickly, and you can rely on their value in months from now. Whereas out of the money is basically just a lottery ticket. We're not playing the lottery here. We're trying to protect our net worth. So in basket one, you could have commodities, which do great in inflation. In basket two, you could have something like staples. So we're talking like food, or I said here railroads as well, which is great for inflation protection. And in basket three, we want puts on long-term bonds, because if there's an inflationary environment, the banks, and it's already in talks, will raise rates to combat this, and we want to be short bonds when that rate change occurs in an inflationary environment. And basket four, I put here other, just to take advantage of maybe high-flying growth stocks, which money will pour into in an inflationary environment with stimulus checks, and value, which will have an even more asymmetrical payout. If you find a really great value stock, why not own some high-quality options on that as well? So this is what the $20,000 looks like in our scenario. So going back to that, that's what this $20,000 is here. It's invested in inflationary assets, which will have this options payoff should it happen, should inflation occur. Okay, so let's look at it. So after 5 months, after a few months, with our savings ability of $4,000 a month, we will have made back our $20,000. So let's look at what happens 5 months out. In scenario one here, we have the inflationary environment. So inflation occurs. Great. Your options pay off. Your net worth kept up with inflation. The central bank raised rates to combat the situation, and your bond put options pay off. Your stock options paid off as well, because the market has skyrocketed from inflation. And the cherry on top is that you still have this $20,000 in debt, which you can now pay back with dollars that are worth less. So you're good. you're happy with situation number 1. In scenario 2, deflation occurs. Well, great. Right off the bat, you still have that net $50,000 on hand, plus the $4K that you've been saving every month. And you can now use this cash to buy cheaper deflated assets. Perhaps your options went to zero, which they likely won't because they're long dated and at the money. But at the most you've lost is this 20K. But because you've been saving $4,000 a month, your net worth is still $70,000 after 5 months. And remember, you're now using this cash to buy cheaper deflated assets. So you're good. You're happy with scenario number 2. In scenario number 3, there's no significant inflation. There's no deflation. There's no market correction or anything like that. Well, good. After 5 months, you've saved another 20K. And your options are still worth the 20K because they're long dated. They're high quality options. So you're good. You're happy with scenario number 3. And you're happy with any situation because you've acted responsibly. This is how professionals look at the markets. And there's many strategies that you can use. This is just one that we can use, especially with this inflation deflation debate going on. I mean, anytime you want to be in a position to make choices, I mean, heads you win, tails you win. If the markets go up, good, I'm happy. If the markets go down, good, I'm happy. And that's a real life option strategy. Cheers.